Welcome to Market Monday from the investment team in the trust department at the First National Bank. We've got some economic reports coming over the next couple of weeks, although it is going to be a little bit lighter than typical, and that allows us to spend a little bit more time talking about the background that's going on at the global macro scale, moving markets and moving interest rates and that sort of thing. So we will spend a little bit of time talking about that. Then we're going to talk about the equities market and the fixed income rates markets to close things off. So over the next couple of weeks, we get information about manufacturing. We're getting information about the real estate market that's expected to show a slight growth in one case, decelerating maybe a little bit on the price increases. Consumer confidence is expected to show a slight decline, but still readings over 100 on this index indicate a pretty robust consumer. Manufacturing, more real estate. Big event's going to be GDP coming in. That's expected to show no change at 2.3. And remember, last time it came in a good bit higher. We're going to talk about that in a few. But when GDP is growing at higher than 2% in a developed economy, the interpretation is we're running a little bit on the hot side. So the expectation is that we are running a little bit on the hot side with growth. And again, that's backed up in the core PCE price index expectations as well. We'll get durable goods information, which tells us what the health of the consumer demand is. You're not buying big ticket items, goods that are lasting over 3 years that are typically financed, unless you think that the economy is looking good, and your personal situation is likely to be good. Moving forward, information about the labor market, inventories again. We're going to get the core PCE, which the Fed is using to gauge inflation effects, and looks like expectations are for a reduction in inflation. We're not so sure about that. We see a lot of signs that indicate inflation's reigniting and is become a concern, including recent commentary by the Federal Reserve officials that suggests that for now they're going to stop with any rate cuts. We're rounding it out, more information about sentiment, demand, and that sort of thing. Labor market, the non-farm payrolls number is very important. That's expected again at 145,000. That number's come in pretty hot most of the time recently, indicating a stronger than expected labor market. And consistently, analysts haven't written up their expectations. And this number has typically surprised to the upside over the past few years, really. The unemployment rate's expected to come in unchanged as well. And these numbers give us a kind of an idea of how things are shaping up in our economy, which does appear that the Fed has allowed us to avoid a recession, and things appear to be pretty strong on the economic front. Now, with that said, earlier a minute ago, I just mentioned that GDP is growing higher than the 2%, and in the developed world, the expectation is that real economic growth of 2% is a sustainable long-term growth rate for a developed economy. And we got a good bit above that in recent years due to monetary and fiscal stimulus that have been going on here in the States and globally in response to the COVID crisis mainly. But with that said, and the fact that they overshot it in a good number of cases, it appears they've overshot, the stimulus, and now we're dealing with the after effects. And that is, this economy is probably not able to maintain a 2.8% growth rate for very long. That was the reading as of the end of December. They're expecting to show 2.45-ish as this number, but we think that it's, all indications are that this number is probably going to remain flat and not come in lower. If it did surprise to the downside, that would be probably very good for market stability, because it would indicate that the Fed got to a sweet spot. The economy is slowly draining off excess, pressure, so to speak, to the acceleration side, and we can get back to more normal market conditions. We just don't see that necessarily happening. So let's look here. Producer price index came in at the last reading at 3.5%, and if you're a chart trader and you see a pattern like this, a higher low, and it's breaking out to new highs, this thing suggests that it's likelier than not going up. And that's bad from the standpoint of corporate earnings, because, producer prices can be a proxy for input costs. And if those are rising, that means that margins could be contracting, unless, of course, consumer prices to proxy sales prices is also rising commensurately. However, it's not. Here's the consumer price index rising at 3%. So, the producer price is rising by 3.5%, and consumer price is only rising by 3% as of the last reading. we're really in a situation where we're seeing contraction in margins, and that potentially has implications for the equity market. So let's talk about that. We've been in a long-term, bullish market. It's been expanding, although that seems to have been slowing down since the very end of last year, where the market seems to have trouble up here near that 6,200, 6,100 area. And now we're seeing signs in, the broader macroeconomic aspect of things that suggest corporate earnings results might become compressed, and that is a catalyst for a potential sell-off. So we are expecting that there might be some volatility later in the year, but again, all of the fundamentals behind the economy appear to be pretty strong, so we wouldn't expect such a thing to be tremendously consequential. So moving forward, this is where we're at, 6,000. We're just flirting with that level. We'll see what happens in the shorter term. This volatility index, the VIX, well, this is important too. We're at 17.6 as of Friday. Volatility expectations have been climbing again, and it's an old school rule of thumb that says, hey, when the VIX gets above 20, you got to start paying attention, and when the VIX is above 25, we're in a full-blown crisis-type panic mode. And, if you look back over the past 5 years, we have spent a very good portion of it in extended higher volatility situations, areas of this chart. So what that suggests is, one of two things. Maybe just as a secular item for long term, where the market has come, things are just more volatile in general. Maybe higher levels of volatility are more normal, so that old rule of thumb needs to be adjusted and updated for modern times. On the other hand, it also suggests that maybe conditions warrant it. And, we have a lot of political things going on. We have tariffs that we have to worry about. We have the decoupling of globalization. We have a deglobalization effect going on that's in full swing. Everybody's back to, being in business for themselves. So that's going to be inflationary. And again, inflation can stoke volatility in markets because, if you have contracting margins, that's one thing. Earnings, the numerator on stock valuation models might be declining a little bit. At the same time, if you have higher rates, that's in the denominator of those functions. So you have a dual pressure on equity prices that could potentially come into play, and we're watching it pretty carefully. But again, we're not advising to make any changes because we're not making changes in short-term, event horizons based on, or to our long-term investment plans, because the general way that the market works is more like this. And, you have your scary periods of turbulence, downdrafts that we all remember very well. However, the end result over long periods of time as a long-term investor works out being the same. So, the Treasury bond market is looking a little bit different as well. Rates have started to come down slightly over the past month from where they were at the longer end of the curve, which suggests that the market is adjusting to the idea that inflation might be coming under a little bit better control from the Federal Reserve. However, it remains to be seen. That's still up pretty tremendously from a year ago. So, looking at the corporate bond market, those numbers are pretty good too. A 5-year paper yielding 4.8, 10-year paper yielding 5.2, 30-year paper yielding 5.6. It's down slightly from its recent levels over the past month, but up substantially from a year and change ago. And these rates are very good for fixed income investors. You're not necessarily investing in bonds because you intend to live on the coupon payments. You're investing in bonds for twofold reason. One is you get that cash flow, and compounding of cash flow is where the real magic of returns happens. And then also it's a risk reduction mechanism. It lowers the overall portfolio risk by the fact that bonds tend to zag when stocks are zigging. So we want to have a balanced portfolio between asset classes designed to optimize risk, and then we want to hang on to it for long periods of time so that we can take advantage of the compounding of returns. And hopefully you found this video useful. And if you want and you have questions about your accounts, about the economy, about markets, feel free to give us a call. We love to talk. Thanks. Have a great day.